A corporate bond crash is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, just as investors are running to the corporate bond market for safety, we're seeing the biggest red flag since 2007, which indicates that corporate bond prices could come crashing down. We'll take a look at what's going on with the corporate bond market and why, even if the Fed cuts rates, that we could see corporate bond yields rise. And is the Fed about to make things worse in the corporate bond market? Well, they say no. We're going to make the case of how they can. And it looks like we have some traction on Washington with the debt ceiling. And even though the Democrats aren't happy, we'll show you why the bond market seems to really like this recent move. And experts are saying the labor market remains robust, but the data today suggests otherwise. And we'll show you why these experts may have it all wrong. Let's head over to Bloomberg, where he picked today's story up with a headline: TD spots a red flag not seen since 2007 coming for the corporate bond market. An issue are shrinking yields on investment-grade bonds relative to an effective federal funds rate, a proxy for funding costs. This carry spread has now reached levels seen only twice before the past 27 years, the last time being in 2007. This is a big issue because right now you were seeing investors and depositors are not feeling overly confident about the banking system, and for good reason. They're looking for alternatives, and high-rated corporate bonds are a place where money is being moved, but that may be a wrong move. As you're about to see, things in this space could get really ugly really fast. And here's one of the reasons. We're going to look at this chart, and then we're going to dig deeper into it. And I want you to see, because when they talk about here, the issue is shrinking yields on investment-grade bonds relative to the federal funds rate. So what you see on this chart is the federal funds rate in blue and the Moody's seasoned AAA corporate bond yield in red. And I've circled these, and I'm going to show you on the next chart an easier way to look at this. But I want you to see there are points where the federal funds rate starts to fall below corporate bond yields, and that starts to spark what is a major problem and leads to higher corporate bond yields. And I want you to note here in red, you see when this kind of inversion happens again. We'll show you again a little easier way to see this, but I want you to note that even though the Fed funds rate comes down, notice how the corporate bond yields tend to tick back higher. And you see that happen particularly in the recessions here each and every time. So this is a major red flag, and here's the easiest way to look at it. When we take the Moody's seasoned AAA corporate bond yield, subtract the federal funds rate, we can now show the inversions below the black line. Here we can see it is inverting now. We see it in 2007. We can see here kind of in the late 80s, early 90s. And then, of course, notably, you see these kind of inversions almost every time precede a recession. And that's a really good reason. The question you might be asking is, why is this such a problem? Because the corporate bond market needs investment money to come in and buy debt as companies issue it. And so as investors look at their options, they could say, hey, do I want to put my money in a AAA or maybe even BBB or some sort of corporate bond to earn a high yield when I can just go over to a money market account that I now know is backed by the Federal Reserve and get effectively a risk-free rate for hacks, perhaps for either the same yield or even a higher yield. And that's what starts to cause problems in the corporate bond market. And that means even though high quality corporate bonds might look cheap based on their mark-to-market values, which have plummeted over the past year's interest rate spiked, the higher cost of funding these positions could still curtail bank purchases and eventually force a move higher in spreads. Now, keep in mind that banks aren't big buyers of corporate bonds to begin with. What this is suggesting is to compensate investors for their risk, that of course corporate bond yields would need to go higher, which means bond prices in turn lower. But one thing I want you to be thinking as we head into a potential recession, perhaps starting later this year, is that one thing that happens with corporate bonds is companies start to have financial issues and their bonds get downgraded, and some of the lower quality ones get pushed into junk status, and that forces yields up across the board. And that's kind of what we're seeing here, is the corporate bond market may not be the safety trade that everyone thinks it is right now. The U.S. recession we forecast in the final quarter this year, along with the recent collapse of Silicon Valley Bank and Credit Suisse, has heightened the risk of a correction in the U.S. investment-grade corporate bond market. Tighter lending conditions ahead will make the case, not just will act as a catalyst for this correction. So again, the issue's coming down to a lack of liquidity because banks aren't really focused on the corporate bond market much to begin with, but they have other problems they're dealing with at a time where investors are looking for safety and saying, hey, you know what, maybe I should just forget about corporate bonds and just stick with the money market rates. And yet the question becomes is tightening lending standards causing a problem? Well, in our monetary system, in our financial system, they always cause problems. Let's take a look at this next chart here. Well, we have Moody's seasoned AAA corporate bond yields less the federal funds rate. So we're going to show that inversion still in blue here against tightening standards for commercial industrial loans for large, mid, and small firms. That's shown in red. And what I want you to see is as the red line rises in value, what you can see is, of course, this leads to a spike in the blue line. You see rising red line, eventual spike in blue line, and you see it happen over and over. Now, in a treasury yield curve, this is different. This means yields are falling. In a corporate bond inversion, what it means is the federal funds rate is falling and corporate bond yields are actually rising because corporate bond prices are falling. And you start to put this in context of a recession is when does the Fed tend to cut rates? Well, when things start to go wrong or when we start to have a crisis or a recession, the Fed starts to cut rates. And what happens to, of course, the economy and corporate profits? Economy weakens, corporate profits fall, investors start to get nervous that they're not going to get their money back on those corporate bonds, and that pushes yields up on the corporate side or even just keeps them elevated against a declining federal funds rate. So what we're seeing here is exactly what this piece just said is tighter lending conditions ahead may indeed act as a catalyst for this correction. As banks important in this context as their sensitivity to interest rates may pressure U.S. investment grade corporate yields to correct, meaning go higher, while unfunded investors, a large share of the market, may be content with a modest yield pickup over treasuries. Liquidity providers need margins large enough to beat their internal funding costs. Again, saying that, hey, we're not going to support this corporate bond market unless yields go up. And of course, we know the Fed, who claims that they're nowhere near ready to cut rates, will likely be cutting them sooner than later. But of course, can the Fed make things worse? Well, we have an upcoming FOMC meeting May 1st and May 2nd. We know what they're likely to do. And I want to show you why, if they keep raising rates, which is what they say they're going to do, they're going to make it worse. Top Fed officials signal support for May interest rate increases as President John Williams says, hey, inflation still too high. And investors see a greater than 80% chance that the Fed will raise rates by a quarter point as May 2nd to 3rd. That's what I said. I said 1st to 2nd and May 2nd to 3rd meeting as Mr. Williams, a close ally of Fed Chair Jerome Powell, offered little to push back against those expectations just days before the central bank officials begin their traditional pre-meeting quiet period when Fed officials don't communicate publicly before their decision. So what I wanted you to see in context of what's going on here is I wanted you to see this inversion in the corporate bond market, and then you see historically the Fed eventually starts to cut, and then we see corporate yields rise. But if you can only imagine now, if the Fed goes through with this rate hike on May 3rd, and that will push this inversion in the corporate bond market even deeper, which will cause a liquidity issue in the corporate bond market as companies that are going out and needing to issue debt to raise capital will find out that there's fewer and fewer investors interested. That will in turn drive prices down of corporate bonds and interest rates back up. And now you start to see it full circle and how the Fed, even though they're saying they're not causing the problem, is a big part of it. Mr. Williams said the stresses in the banking system has stabilized. Well, the corporate bond market says no way, not even close, and he anticipated they would lead to tighter lending standards for households and businesses, which they indeed are, and that would lead to a reduction in consumer spending. To state the obvious, when consumers can't get loans, they spend less. That is just a matter of fact of how our economy works. So yes, Tighter lending standards, Mr. Williams, you got it, will lead to a reduction in consumer spending, but he said it was too soon to judge the magnitude and duration of such tightening, even though their own reports suggest otherwise. He also said that signs of both demand for labor and inflation were cooling, and he said he expected inflation to decline to around 3.5% this year. Of course, we made the case why this is likely to head below their target by the end of the year, and we're going to make the case why the labor market here in a little bit is far worse shape than we thought. But first, the question is, why is the bond market seemingly happy over Speaker McCarthy's plan for a budget resolution? Well, it's not exactly for the reason you think. As Biden slams McCarthy, tells him to take the default off the table in the debt ceiling fight. As Biden was speaking, McCarthy announced his plan of his own speech on the House floor, and he's calling to lift the debt limit by $1.5 trillion, or until March 31st, 2024, slash federal spending by $130 billion, limit spending increases to 1% a year, and set the fiscal year 2024 spending levels at that of fiscal year 2022. And he said his office said it will result in a $4.5 trillion savings. Of course, we never can trust any sort of savings number that's coming out of the government, but that's not the point. Is why is the bond market suddenly happy? Why did we see when Speaker McCarthy came out and announced his plan that all of a sudden yields started to come down a bit? Is it because, of course, that the answer is simple? Would you say it's because the bond market is endorsing Speaker McCarthy's plan, believing that it's going to pass, or is it something else? Well, the reality is the bond market doesn't know if the bill is going to pass, and we know historically it's unlikely. He's got a long road ahead to convince his own party that this is the right thing, and by the end it's going to change, and there's going to be more bills and options coming out from both sides of the table. What the bond market is relieved to see is that negotiations have now begun, which means that at some point, if we get close to the deadline, that both parties will agree for a temporary suspension of the limit or debt ceiling, or raise it, allow at least bondholders to continue to get paid, and everything will be good until they figure it out. That's why the bond market's happy, not because it cares about either side in the story. It just cares about those who own T-bills getting paid. And now let's take a look at what's going on at the Fed, because I want to lead this into what's going on in the labor market today. As you see, things just aren't as good as, of course, John Williams suggested they might be. The Beige Book sees slowdown in employment and inflation, sharp tightening in credit standards, and spike in liquidity concerns. These are not things you would hear in the Beige Book from, of course, a strong economy. Keep in mind, this was data collected on or before April 10th by the regional Fed banks. As turning to the labor market, this from Zero Hedge, the Beige Book notes that employment growth moderated somewhat in this period as several districts reported a slower pace of growth than recent Beige Book reports. A smaller number of firms reported mass layoffs. So again, these are not things you hear in a robust economy that you would want to tighten rates into, particularly one when there's an inversion not only across the yield curve of the Treasury market, but in the corporate bond market as well. The slowdown wasn't only in labor markets, but also inflation, as overall price levels rose modestly during this reporting period, though the rate of price increases appeared to be slowing. While peak inflation is clearly behind us, some regions are already experiencing, wait, what? Deflation, as contracts noted modest to sharp declines in the prices of non-labor inputs and significantly lower freight costs in recent weeks. Again, these aren't signs of a robust economy. Let's dig a little deeper in this report, and then we're going to get into the labor data, because what we're going to see, what I'm going to predict, is we're going to start to see a rapid move higher in unemployment claims at a time when experts are saying where we're at is not a problem. We're going to make the case otherwise. But let's dig a little deeper here first. As conditions in the broad finance sector deteriorate sharply, coinciding with recent stress in the banking sector. Small to medium-sized banks in the district reported widespread declines in loan demand, meaning less new money being created across all segments. Credit standards tightened noticeably for all loan types, even though Williams said, hey, I'm not sure if it's that bad. Yes, yes it is. And loan spreads continued to narrow. Deposit rates moved higher, and finally delinquency rates edged up on residential and commercial mortgages. Lending volumes and loan demand generally declined across consumer and business loan types, and several districts noted that banks tightened lending standards amid increased uncertainty and concerns about liquidity. Again, these are all things that you tend to see either in a recession or heading into recession. But as we see now, we're going to head back to Bloomberg. You're going to get this picture that, hey, what's going on in the labor market isn't really a big deal. I'm going to make the case very much otherwise, as you're about to see. As U.S. recurring jobless claims jumped to the highest since November of 2021, continuing claims increased, but get this, initial applications ticked up, but remained, and this is key word, at a low level. So let's check this out. I want you to see the report, and then I'm going to show you a chart that'll blow you away and show you why that even at this low level, initial claims are a problem. And here we can see initial claims at 245,000, increased 5,000. So this historically is technically low, it's still at 245, but the trend is moving higher. The continuing claims jumped 61,000, but total claims dropped 50,000. The question is this because people are finding jobs that have been on unemployment for a while, or maybe they're exhausting their benefits? But let's answer the question, are these claim levels low and almost insignificant? Well, if you'll notice, this red line here is right around 350,000 claims is where it's listed at. And you'll note that in a normal economy, when you get somewhere near 350,000, when you see that claims bottom maybe around 200,000 or so, that's where we hit a recession. The green line is at 250. Now, why did I put it at 250? Because when you see initial claims historically at super low levels, then all it takes is a small increase, and that number is around 250,000. When you start hitting 250,000 and higher of initial claims, you start to get the signs that the labor market can't hang tight. That's your recession signal. You've also got the inversion of the corporate bond market and the Fed, who's completely clueless and may still hike rates on May 3rd. Things are getting very interesting very quickly. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.